Good morning, everybody, and welcome to the show. This is Taking Stock at Vox Markets. Another busy day in the markets. We've got updates from a variety of companies. We've got the likes of Vianet, Checkit, we've got IBST, we've got Focusrite, which I know a lot of people follow. We've got TriFast, Eco Animal Health, and a few others, perhaps we may get around to. So thank you all very much for joining us. Hello to George in the live chat. Please subscribe if you're new. Smash that like button. It really helps us a lot, and we appreciate it. And without further ado, let's get into the show. So I'll share my screen. Here's the Vox homepage. So a couple of updates that have gone up this morning, so we can check them out maybe later. So I think we'll start with Focusrite because it's a popular one, and it's not a small company, not too small, £209 million. Shares are down by 4% today. This one had a COVID boom, and then it had a post-COVID bust, and the share price has been struggling. Let's check out what we've got in these interim results. So I know if you're a Stockopedia subscriber, you'll have seen Paul Scott covered this at Stockopedia this morning in the report, which I do with him there. A key factor here, as highlighted by Paul, is the inventories issue. So I suppose we'll get into that as we go through it. But what does Focusrite do? It provides hardware and software for musicians and the entertainment industry. So it includes things like podcasters, people creating content on the internet. I don't know if you know anybody who does that. A wide variety of brands included within Focusrite. A key point is that the chairman is in fact the founder and has a 32% stake in the business. So a good bit of insider ownership and still, leadership from the founder there, which is important to note. So after COVID, this business has struggled to get its mojo back. It's as they say here, 13 distinct brands. There was a near doubling of revenue from pre-COVID until today, but of course, the post-COVID bust has been difficult. And as they say here, the content creation division has faced a particular set of challenges with both macroeconomic weakness and an oversupply in the channel. So I think oversupply is a key word there in relation to a potential inventory issue. They're navigating the transition of one of their ranges to the next generation. And they say that the industry outlook remains tough. They remain encouraged by product registration data, which is outperforming the market. So a tricky sort of situation here with oversupply and as we'll see, the inventories growing. Revenues, as you can see, are down in the first half of 2024. Margins are down as well, which again comes back to the inventory issue. What margins will be achieved on their pile of inventories? Adjusted EBITDA is down, a metric I generally don't pay too much attention to, and so on. And net debt rises to £27 million. Not a huge number if the company can get its mojo back, but but not what you want to see. So let's scroll down here, and we've got they've got, as they say here, higher working capital levels with higher stock in audio reproduction to support growth and higher debtors. So we'll have a quick look at that cash flow statement and see what's happening there. Yeah, okay. So maybe we'll go straight down to the financial statements here, but it's a tricky one because it seems like they're still on the downslope, and it's never comfortable to buy a company that hasn't yet started its turnaround. Let's do a Control F on inventory. Okay, so you see here, for example, they say, despite a stabilization in prices and availability, these challenges, coupled with a softer macro landscape, have led to the current excessive inventory levels across various product segments in FY24. So that's a cause for concern. They also say global inventory rebalancing has continued, and so on. So, and they also say that they are trying to sell the fourth generation of one of their products while the market continues to absorb the remaining third generation inventory. So that doesn't sound good in terms of the value of any remaining third generation inventory when there's a fourth generation product being sold. And you can see that they have made a provision of £1 million against inventory. So I don't want to keep going on about this, but I just wanted to reiterate and sort of expand on points that Paul was making earlier. There is a serious inventory issue here. It is highlighted throughout the report. Let's get into the cash flow statement before we finish up on this. So we'll just go straight down to the balance sheet. And we've got inventories of £55 million here. A significant number for a company of this size. And that's an increase compared to where we were a year ago. And I suppose that's after making a provision against it as well. Total equity, £118 million. So out of the £118 million, you could, in a sense, argue that half of it is tied up in inventories. So I think that is a key issue. In terms of the broader picture here, market cap £200 million. Am I tempted by this company? I would have to say no. And I hope you appreciate that. I do try to be fair with companies. I try to be positive whenever I can, and I'm positive about lots of companies. You could argue I'm positive on too many companies overall, but in this particular case, I can't take a positive view. I'm not seeing enough here, but let's keep it on the watch list for turnaround. So in the live chat, we've got a few comments. Paddy's asking about Destiny Pharmacy. I may take a quick look at that later. And Rif Safab says, people might be less keen on buying musical instruments because AI can make music and is getting better at it. Well, that's an interesting point. This company is in the hardware and software gig. So not exactly the same as musical instruments, but it's an interesting point. Okay, thank you very much for your comments, and keep them coming, please. So Focusrite, I'm not tempted, but I would keep an eye on it for signs of improvement. Things will not stay this way forever. So we can head over to IBST now, I think. we've got some fairly short trading statements that we may be able to fly through. So this is the UK's largest brick manufacturer, founded all the way back in 1899 as a coal mining business. So the nice little description here on Vox you can read about how the business came to be. And now they describe themselves as providing building products and solutions. And they had a pretty terrible year last year, which, obviously we've been making comments about the construction industry and hoping that 2024 will be better. With this first quarter trading update sees the shares down 1%, market cap the best part of £600 million, so decent sized business. But this trading update, I'm surprised that the shares are only down by 1% today, because I thought this trading update was quite bleak in in many ways. They say trading conditions in the first quarter remained challenging, with activity levels across residential construction markets remaining subdued during the period. As a result, sales volumes were below our expectations, with weaker end market demand, in part reflecting the exceptionally wet weather experienced across the UK. Now, I think we were looking at Breeden, and we were talking about the weather. Yes, there has been exceptionally wet weather. So you can sort of you can chalk the difficulties in the construction sector partly to wet weather, but I think I don't think you can fully blame the situation on the weather. What else do they say? They have there were cost reduction actions. There was commercial discipline. Okay, adjusted EBITDA in line with expectations. Okay, that we've got a positive. They also say lead indicators suggest some improvement in future demand. Okay, there's a few positives that you can sort of cling on to there, but this company is in need of a turnaround, and the turnaround isn't here yet. So it's I don't know what else to say. I wouldn't be too tempted to trade this one just yet. I mean, at the end of the day, it's probably just an interest rate issue, in terms of how we're going to go for the rest of the year and the new year. That's my personal opinion. But look, I don't blame the company for any of this. Tough market. You make bricks. You can't control the demand for bricks. So there you are. We've got a comment from Matt. Ibstock, along with Forterra, Michelmersh, and Brickability, any views of consolidation in the sector? I've only had to study the brick companies a couple of times in my analyst career, and I couldn't find huge differences between them. So maybe they should consolidate. When you see companies that are all very similar, doing similar things, why not merge and get a better deal for themselves in terms of pricing and improve their market share? So yeah, I'm all for consolidation in the brick industry, but I've only had to study it a few times, so I'm no brick expert. It strikes me that this company just needs interest rates to fall. But there we are. That's Ibstock. Not a bad company by any means, but it can't control demand. So that's Ibstock. Where we go next? Let me know if you have any more suggestions. Will we change things slightly and go and do Eco Animal Health, EAH? So this provides veterinary medicines, I guess, pharmaceutical products for global animal health markets. Not too big of a market cap, only 70 million pounds, but the shares are up today. And I do like the theme, I must say. I think it's a very nice theme, animal care, because it seems to me that people are only going to spend more and more on animals over time. So what have we got here? We've got a decent update, I think. Revenues will be in line with expectations, and they give us these expectations, which is very helpful. Revenue, as at the date of this announcement, expectations are £88.7 million. With full visibility on trading for the year, the company can report that final revenues were greater than market expectations and nearly £90 million. So that's financial year March 2024, and they've beaten expectations. So that's good news, and that's despite foreign exchange headwinds. And yeah, so as I said, a solid update from Eco Animal Health. Now, what was my point on this? Yeah, my point on this one was that actual after-tax net income has been pretty low at this company. So if you try and look at a PE ratio for this, you'll probably get some very big numbers. So really, this one needs or is priced for its sort of net profit margin to improve. That's kind of what's priced in here. In terms of price to sales, the price to sales multiple is less than 1. So yeah, I can see where the market is coming from, pricing this at 70 million pounds. If they could just get slightly cleaner results, they'd we would see a reasonable PE multiple on this. But as things stand, the PE ratio is very high. So like you can see here, we've got a 65 times number there based on 2023 numbers. I think if you do on 2024 numbers, you get something like 30 or 40 times. So a very big PE multiple here, but price to sales multiple less than 1. So I think it has potential, but I'm not racing to buy shares in Eco Animal Health right now. But seems like it has some potential. George in the comments says Paul Hill holds Michelmersh, and he believes that they are more specialty brick suppliers that are more expensive. Oh, well, thank you for that. Yes, there are some differences between them, but yes, requires some detailed research in the brick industry if you're interested in that. Okay, let's do Vianet just to mix things up. We've got plenty more of these little updates to hop around. Vianet has been listed for a really long time. I always associated with pubs, with monitoring the flow of beer, but it's a lot more than that now. It's got various payment solutions, contactless payments, vending machine technology. I think if you buy fuel, they can monitor or facilitate the purchase of fuel or petrol, diesel without needing to pay in person. So yeah, quite a wide range of products there, and all very sort of well, maybe high tech is taking it a bit far, but certainly decent technology involved here. But it's been around for a long time, and my sort of issue with it was that for years and years there was very little growth. So it just looked like a kind of a boring business. But you see the shares are up by 10% today, and this trading update and the contract win. So we've got some decent news here. So maybe we need to check our sort of biases and not think of this one as being X growth. So you can see their description is they are a leader in delivering actionable data and business insights through an integrated ecosystem of hardware devices and so on. So I mean, look, it's a horrible description. I'm sure there's a plain English version of this which would help people far more to understand what they do. I suppose that's one of my little bugbears is company descriptions which don't actually tell us what they do in a real sense, and also they use the word ecosystem, which is another word which I think is misused. So I'm not, I have to admit that I'm not impressed by the company's self-description, but I do like the company. I like their actual products. And this is an excellent trading update in the sense that we've got actually a proper growth number here, 7.6% revenue growth. We've got recurring revenue, now 85% of total revenue. Okay, that's slightly lower than last year. And we've got an improvement in gross margin, and the net debt is tiny, £1.5 million. So all pretty positive there, I would say. They've got they made a strategic acquisition in May 2023 that has significantly accelerated our product roadmap in the hospitality sector, shortening development timelines by approximately 12 to 18 months. So more good news on that front. So this is the key point. We've got unattended retail and hospitality divisions where progress has been particularly strong. And what did they say about, did they say anything else specifically about the hospitality industry? They don't. But overall sounds positive there. And let's check out their contract win that they've also announced. So they announced a notable strategic contract win with a company called Wilcomatic Wash Systems, the UK's leading provider of commercial vehicle wash systems for petrol forecourts. So, I mean, that sounds very much sort of compatible or synergistic with what the their existing products. So they say that Vianet and its key partner have strengthened their presence in the UK car wash and valeting market by securing the rollout of their contactless payment solution on a 5-year agreement with Wilcomatic. So there's no major sort of numbers here, but it does certainly sound good. And this is an RNS, not an RNS reach. So you would think that this is material, and so yeah, just more positive developments there. So the bottom line is that I think Vianet may actually be a growth company after all. After many years of no growth, maybe they're now in a position of financial strength and ambition where they can actually go ahead and surprise and impress us with a bit of growth. So yeah, good news there. And I mean, for a company that's been around for so long, you do tend to trust it. Okay, we can look at Checkit now. So this is one where I think that, if I'm not wrong, the historic financials here will show quite significant losses. So, for example, 2023, we have revenues of £10 million and a pre-tax loss of £12 million. So, I'm not opposed to taking a positive view on early stage companies. Like I do sometimes take a very positive view on unprofitable companies, but I don't tend to get involved in companies where they're very early stage. And for me, when you have losses which are bigger than your revenue, I think that puts it in another category. It's not just early stage, but it's sort of really early stage. Now, we've got results here to check out. The shares are down 3%, quite a low market cap here, only £22 million. What do they do? Well, they say that they are an augmented workflow and smart sensor automation company for frontline workers. So, for example, I was looking at their website again today to remind me. They provide medical temperature monitoring, so they can monitor medical items, and they can also get involved in food safety. So that the temperature of food doesn't need to be checked, for example. Interesting technology. And what have we got in terms of the results here? Well, we've got 16% annual recurring revenue growth, which is not to be sniffed at. That's a very nice growth number, in line with market expectations, despite a challenging global economy. Net revenue retention of 111%, which says to me that, if I understand the metric correctly, that their existing customers are increasing their spend with Checkit, which is very good. And they say progress towards profitability with a 46% improvement in adjusted EBITDA. So that's loss before interest, taxes, and so on. So EBITDA is £3.4 million, whereas previously it was £6.4 million. And they finished the year with net cash of £9 million. Previous year they had 15.6. So okay, I mean, it's not a bad start, but we'll get down and have a look at the actual statutory numbers in a second. But before we do, where's the outlook statement? It says trading has been in line. We continue to execute against our growth strategy and develop our technology while progressing on our path to profitability. And they say they expect to reach break-even in FY27. Important to bear in mind that some companies, when they say break-even, they mean EBITDA break-even, which is very different to sort of actual statutory bottom line net income. And the way they say progress towards profitability, and then they mention EBITDA, would lead me to sort of assume that they mean EBITDA break even when they say FY27 could be break even. The CEO says we've successfully reduced financial losses by 46% while continuing to escalate our growth, on track to become cash flow break even, and anticipate posting a positive EBITDA performance in FY27. So that's exactly what I just said. By break even, they mean positive EBITDA or adjusted EBITDA. The launch of our new product, Asset Intelligence, marks an exciting chapter in the evolution of our offering and demonstrates the synergies in the Checkit product ecosystem. So another company with an ecosystem. Okay, so we'll just go down to the income statement here. So you can see we've got revenue of 12 million. The adjusted EBITDA is 3.4 million. And then the pre-tax loss is 4.6 million. So to give credit where credit is due, this is a much lower loss than last year. and it's no longer in the category which I sort of actively avoid. So, as I said, I actively avoid companies where losses are bigger than revenues, as being way too early stage for me to even really look at. But now they've reached a point where revenues are much higher than the loss. So they're much closer to getting a real break even. Another positive point I would say is that the gap between the adjusted EBITDA and the pre-tax loss is not that huge. So another positive sign. So actually, I would definitely be a lot more open-minded towards Checkit than I was before. One of my most successful stocks that I've been positive on over the last year or two has been Trustpilot. Okay, it's a much bigger company than Checkit, but the point there was that I latched onto it when I could see that they were on a trend to profitability. And so maybe uh, Checkit will get to profitability before too long. And I would also point out that if the gap between adjusted EBITDA and the actual pre-tax profit or even after-tax profit, if that gap is small, then FY27 could see something that's close to a real break even, a real pre-tax profit. So look, it's still an early stage company in my book. It's still probably much higher risk than your blue chips. Okay, it's a small cap and it's growing. It's in that sort of high risk group, but I would definitely be a lot more open minded towards Checkit now than a year ago, and could be worth checking out in more detail. To pun not intended. Okay, cool. So that's Checkit PLC with an update. Let's do this one next. So this is kind of in a similar category, Skillcast. What's interesting about this one is that if my calculations are correct, 78% of this company's shares are owned by insiders, including 59% owned by the CEO. So that's obviously a huge stake in percentage terms. Not bad in absolute terms either. 58% or 59% of 34 million is a decent amount of value for any individual. And what's the point here? Well, yeah, so we've got extreme high levels of insider ownership. That does mean that the free float is going to be very small. So if there's only 20% of the company that's available to trade by non-insiders, that's very small. So that could result in an extremely volatile share price. And I suppose there's signs of that with the share price having already almost doubled compared to September last year. So, if this could be, when you've got something with such a tiny free float, you can get some kind of crazy share price movements because the free float's only well, it's less than £10 million anyway. And what else do we want to say about this? Well, let's look at the news. Well, what do they do first of all? They provide compliance training for businesses, and that's a decent niche to be in. They say that they can save companies money by providing them with all the compliance training that they need, and then we've got results here. Now, again, this is a small, unprofitable company. It again uses EBITDA, but the difference between this company and Checkit is that it's kept its EBITDA, its losses, very low. This EBITDA less than £1 million both this year and last year. So that's something I love to see, because even though I am willing to take a positive view on unprofitable companies, and including unprofitable growth companies, I do really like it if they can keep their losses low. So this is a less than £1 million of negative EBITDA. So that implies that they're not going to put too much strain on their cash balance. You can see cash in bank didn't change too much, £7.7 million down to £7.2 million. So that sort of backs up what I'm saying here. Before I go into the commentary, I do want to check the cash flow statement. So, yeah, they've even paid dividends, which I can barely believe, but they've paid dividends. They've not raised any money, and they're getting interest on their cash balance. And cash generated from operations was actually positive. So, for a loss-making company, there's a huge amount of positives in the financial performance. In terms of the loss before tax, you can see that their EBITDA was negative 600k, and their actual pre-tax loss was pretty much the same. So, like, if this company, if I was ever trapped in an elevator with this company, whoever's writing these reports, I would say, why don't you just bin EBITDA? You don't need it, because your pre-tax profit is, or your pre-tax loss is, basically the same number. So why mess about with EBITDA? You can produce a much cleaner number for investors, and I think they'll appreciate it. I think investors will like seeing a clean number instead of bothering with EBITDA. So that's kind of the first main point I wanted to make here, that despite losses, there are significant positives and mitigating factors in the performance. In terms of revenue growth, 15%, another revenue growth number not to be sniffed at. Annualized recurring revenue up 37% to 9.3 million. And so if this company was given a United States valuation of 5 to 7 times ARR, that would imply a valuation of, say, 45 to 63 million pounds. And then you have to add in the cash in bank, which gets you to 50 million pounds plus. So these are just back of the envelope calculations, but to me, it's a very positive story. It's a story of rapidly growing ARR, and maybe the market will choose to attach a decent multiple to that at some point. And if it keeps growing at this rate, well, that would obviously be amazing for shareholders long term. So any other points I wanted to highlight here on Skillcast? Just look at my notes here. Now, those were my main points on this one. Do we get an outlook statement here? So we have entered the new financial year in a good financial and operational position. Our recent product enhancements and new go-to-market strategy have increased inquiry levels from potential customers, which we are working to convert into additional subscription revenues. Professional service activity remains challenging due to ongoing delays in corporate decision making. And then they say, and this is, I think, very positive, as of the end of Q1, our ARR, annualized recurring revenue, was £10 million, up 36% from 12 months ago. The board remains confident of meeting market expectations for the year ahead. of returning to profitability and delivering on its long-term strategic plan. So ARR up 36% year on year as of the end of March. So not exactly matching the 37% growth, but 36%, I think shareholders will probably settle for 36% year on year in March. And again, 10 million pounds ARR, attach a multiple of 5 to 7, you get 50 to 70 million pounds, and then you can probably add in the cash, because the correct multiple to use is enterprise value to ARR. So you can add in the cash to get your valuation estimate. And so for me, I would say that this is promising. Not a recommendation, not advice, and I don't own shares in this, but purely on the basis of what I've read this morning at Skillcast, I just have to express my opinion, and I very much like what I see, and I like the theme here, e-learning, and training online for businesses with their compliance. For the company's overall purpose, our purpose is to enable companies to build ethical and resilient workplaces, and our vision is to be the leading provider of digital training and technology for workplace compliance. Companies face an ever-increasing burden of compliance, and at the same time are facing a real need to find efficiencies in the current cost-pressured environment. So you can read on there if you're interested. But I must say I like the theme. Sounds like they're executing it very well, and with with a company that comes to the market with nearly 80% of its shares owned by insiders, and the insiders are sort of just hanging on to these shares, I think that's very interesting. I mean, maybe they're going to maybe they're planning to sell their holdings soon. I have no idea, but I think it's curious that they've held on to so many shares despite coming to market. So we'll see what happens there. Skillcast Group, I think, is worth research, and best of luck to them. Okay. Now, I didn't intend to spend so much time on that, but it was quite an interesting story, in my opinion. Will we go and do TriFast next? So TRI. So this is a company that provides industrial fastenings and components. This description here: they are a leading international specialist in the engineering, manufacturing, and distribution of high-quality industrial fastenings to major global assembly industries. Now, if you look at the TriFast's historic performance, you will see that they had a profit warning not that long ago. Long term, the share price, unfortunately, has not been a great performer, and earnings tend to be very volatile. So it's kind of just a low margin situation, I'm afraid. You can see we've got numbers here to March 2023, revenue 244 million, and an operating profit of basically zero. So low margins, but let's check out what they have to say. Market cap of 109 million pounds. So this is something I always look out for. You've got revenues of well over 200 million pounds. You've got a market cap of 109 million pounds. So if these volatile earnings have a few good years, then that could do wonders for the share price. So anyway, we've got this trading update from TriFast. They say, against a backdrop of continued subdued demand conditions in a number of geographic and end market sectors, their performance in the final quarter was resilient and supported by the self-help initiatives launched during the year. So in fact, revenue and profitability are expected to be marginally ahead of guidance indicated in the announcement of 22nd of January. Now, I think that that January announcement was a profit warning, so important to bear that in mind. It's not like they're on a consistent uptrend of expectations here. They've had a downgrade. Now they're saying that they're marginally ahead. And what else where should we focus on here? Leverage is less than 1.3 times net debt leverage. So pretty reasonable number here. You would say that that's probably should be comfortable, assuming that there's no sudden collapse in profitability. And any other points here? They are committed to delivering savings of £3 million. So not huge, but doesn't hurt, I suppose. With a market cap of £100 million, the £3 million annual saving is worth something. Could make a significant difference. And strong cash generation, they say, ahead of targets. So pretty decent stuff here, I'd say, from TriFast. I'm not expecting it to shoot the lights out anytime soon, but who knows? Maybe they could give us a couple of good years soon. Let's head over to the homepage here at Vox and see what people are looking at in terms of the most read RNS. We've got Greatland Gold in number 1, Destiny Pharma. So I think that's what Patty was asking about earlier. Anglo is in here, naturally. Anglo shares up 13.5%. Argo Blockchain comes in with its annual financial report and a few other bits here. I'll just click into this because one of our viewers was asking about it. Destiny Pharma, a clinical stage innovative biotech company focusing on the development of novel medicines that can prevent life-threatening infections. So these are 2023 results. Unfortunately, I'm no expert in biotech, but let's just point out the highlights here. Loss before tax reduced to 6 million from nearly 8 million the prior year. R&D expenditure 3 million, down from 5 million, and they say they are funded through to Q1 2025. So that's good. That's some level of runway. I guess it's less than a year, you could argue, but some level of funding runway. So that's Destiny. I don't have a strong view on this one. Just thought I'd mention it in passing as a viewer was interested in it. We've also got Argo Blockchain published 2023 results. This is just sort of a curiosity for me because I did study it in detail before the wheels fell off, and then it sort of changed its strategies and management. So I like to just see what it's doing now. Unfortunately, we do have a net loss of $35 million compared to a net loss of $229 million the prior year. They had to do this deal with Galaxy Digital where they sort of handed a lot of, if I remember correctly, they handed a lot of assets and control over to Galaxy Digital, and they ended up in debt to Galaxy Digital. So it was, it was a move that they were kind of forced into when they were in desperate straits, and they now owe $23 million to Galaxy Digital as of the end of 2023. Total debt outstanding of $66 million. However, they raised $10 million in January, and in March, they sold a data center for $6 million. So this one, as I said, the wheels came off this one some time ago. Can it get back into strength? I mean, like the way I interpreted this stock was that it was an easy way for stock market investors to get exposure to the Bitcoin price. Like that was kind of the point of it. But now it seems more like a special situation where the company is in debt and mining costs have gone up. They've had to sell a bunch of assets, and it's it's quite a lot of difficulty. And it's still I find it interesting. I hope it works out for them, but a bit of a special situation now, I'd suggest. Let's see if we got any media here that we can review. Yeah, there's a few bits and pieces here in the archive that you could check out for more on Argo blockchain. Okay, folks. I think I've covered pretty much everything I intended to cover today. There were a few more announcements, but I don't think anything too earth-shattering. If I've missed anything that you'd like me to cover tomorrow, I can take a special note of that. But yeah, I'll see you tomorrow for more. And I hope this was interesting. Please do smash that like button. It helps us out a lot. And enjoy the rest of your day. We've got a request for Weatherspoons. Okay, I will check out if that one if I can get around to that one, Weatherspoons. So yeah, whether you're watching live or on the replay, appreciate your feedback and enjoy the rest of your day. It's been a pleasure, and good luck to everyone. Okay, bye for now, and here comes the outro.